The camera opens on massive container ships stacked high at the docks, trucks pulling out from factories, and digital price tags flashing across grocery aisles. Bold text appears on screen. Trump Tariffs 2025. Inflation still looks calm on the surface, but America's factories are already slowing down. July's Consumer Price Index rose just 0.2% month-over-month and 2.7% year-over-year. Steady numbers from the Bureau of Labor Statistics. Yet industrial production slipped 0.1% in July, and auto and parts output dropped 0.3%. A warning sign hiding behind the headlines. Here's the hook. Inflation may look tame, but which U.S. state will crack first under the pressure of tariffs? Trump's latest trade moves raised steel and aluminum duties to 50% this summer, while the 25% auto tariff is still in full force. Japan already cut a deal down to 15%, giving its automakers some breathing room, while the European Union is still at the negotiating table. This uneven playing field means some states face the full hit, while others get temporary relief. In today's breakdown, we'll reveal the top 10 U.S. states most at risk, from auto hubs to oil giants to tourist hotspots. Stay tuned, because the cracks are already showing. Tariff Macro Snapshot 2025. Trump's tariff wall is now fully in place, and the numbers tell a sharp story. The auto tariff remains locked at 25%, while Japan secured a deal in July to bring its rate down to 15%, giving Toyota and Honda a softer landing. Steel and aluminum duties were pushed to 50% back in June, with the scope expanded further in August, hitting construction and manufacturing supply chains harder than before. On the surface, consumer prices still look steady. The Bureau of Labor Statistics reported that July's CPI rose just 0.2% month-over-month and 2.7% year-over-year, well within the Fed's comfort zone. But production tells a very different story. The Fed's G.17 report shows industrial output slipping 0.1% in July, with auto and parts production falling 0.3%. These are small numbers, but they point to deeper cracks beneath the surface. Why isn't inflation spiking? Loopholes, exemptions, and early stockpiling have delayed the shock, keeping CPI in check for now. Yet behind that calm exterior, factories are slowing, supply chains are tightening, and states tied to autos, metals, and energy are already feeling the strain. How we ranked the top 10. Before diving into the countdown, here's how the rankings were built. The first and most important factor is industry exposure, accounting for 35% of the weight. States tied heavily to autos, energy, or tourism feel tariff shocks faster than others. Next comes fiscal and healthcare buffers, worth 25%. A strong rainy day fund or stable hospital network can soften the blow, while weak budgets and fragile systems make collapse more likely. Consumer and tourism sensitivity is 20%. If households cut spending or visitors cancel trips, states that rely on sales taxes or hotel bookings lose revenue almost overnight. Natural disaster and infrastructure risk counts for 10%. From hurricanes in the Gulf to power grid failures in Texas, stress multiplies when shocks overlap. Finally, market and demographic signals make up 10%, including migration trends, bond yields, and long-term population shifts. This transparent framework explains why some states rank higher and why others may crack first. Number 10. Mississippi. Mississippi ranks as one of the most fragile state economies in America. Household income here is the lowest in the nation, leaving families with almost no cushion when prices rise. Tariffs on imported goods hit especially hard, as even small cost increases ripple directly into daily living expenses. Infrastructure across the state, from roads and bridges to rural hospitals, is underfunded and struggling to keep pace. Foreign direct investment plays only a limited role in the state's economy, meaning there are few outside lifelines when local industries slow. Mississippi does maintain a rainy day fund, but it remains thin compared to the scale of potential shocks. This combination of weak incomes, fragile infrastructure, and limited buffers makes the state highly sensitive to inflationary pressure. When tariffs tighten supply chains and push prices higher, Mississippi is often the first to feel the full weight. Number 9. Louisiana. Louisiana stands out as both an energy powerhouse and one of the most disaster-prone states in the nation. The state is home to nearly 1/6 of U.S. refining capacity, making it essential for gasoline and petrochemical supplies across the country. That strength also creates vulnerability, because tariffs on steel, aluminum, and imported equipment raise costs for the very industry Louisiana depends on. Global oil price swings and higher input costs ripple quickly through local jobs, revenues, and consumer prices. On top of trade pressure, Louisiana faces an even greater threat from nature. The NOAA forecast for the 2025 hurricane season is above normal, with stronger and more frequent storms expected in the Gulf. A direct strike on refineries, pipelines, or ports could combine physical destruction with the financial squeeze of tariffs. For Louisiana, the risk is a double bind: trade policy on one side, extreme weather on the other. Number 8. Michigan. Michigan remains the heart of America's auto industry, and that makes it one of the most exposed states under the current tariff regime. General Motors has warned that new tariffs could cost the company between $4 and $5 billion this year, directly threatening thousands of jobs across assembly lines and supplier networks. Stellantis has also issued cautions, signaling that the second half of 2025 may bring deeper financial strain if tariffs continue to weigh on parts and production. The Fed's G.17 report shows auto and parts output already slipping by 0.3% in July, a red flag for an industry that fuels so much of Michigan's tax base and household income. When production slows, the consequences cascade: fewer shifts for workers, lower revenue for local governments, and shrinking demand for small businesses tied to the auto corridor. For Michigan, the message is clear. When the auto sector sneezes, the state risks catching a severe economic cold. Number 7. Texas. Texas is often viewed as an economic powerhouse thanks to its dominant role in oil and gas production. High global prices can give the state a temporary boost, but that same dependence leaves it highly vulnerable when markets swing in the opposite direction. Tariffs raise costs for drilling equipment, pipelines, and imported steel, adding pressure to an industry already tied to volatile demand. Beyond energy, Texas struggles with infrastructure risks that have already been exposed. The 2021 power grid collapse showed how extreme weather can push the system to its breaking point, leaving millions without electricity. Despite reforms, experts warn that another surge in demand or an unexpected storm could trigger rolling blackouts again. Rural healthcare is also deteriorating, with dozens of hospitals closing since 2010 and many more now at risk. Together, energy dependence, grid fragility, and weak healthcare systems mean that Texas, beneath its strong image, carries far more cracks than it appears. Number 6. Illinois. Illinois projects the image of strength with Chicago's skyline and world-class universities, but beneath the surface, the state faces deep financial stress. Years of mounting pension obligations have crowded out funding for schools, infrastructure, and social programs. This structural burden has made Illinois one of the weakest states in terms of long-term fiscal health. Since mid-2025, bond yields on Illinois' state debt have begun to tick upward, signaling that investors see higher risk in its finances. At the same time, major corporations have shifted headquarters or operations out of Chicago, eroding both jobs and tax revenue. Each departure makes it harder to balance the budget, forcing higher property taxes on those who remain. While Illinois is not on the edge of collapse today, the trajectory is worrying. Without structural reform and renewed investment, the state's fiscal strain will keep intensifying, leaving ordinary residents to bear the cost. Number 5. Hawaii. Hawaii's breathtaking landscapes hide one of the most fragile economic foundations in the United States. Tourism accounts for roughly 24 to 25% of the state's GDP when direct, indirect, and induced activity are combined. That means nearly $1 in $4 flowing through Hawaii's economy depends on travelers arriving by plane or cruise ship. Tariffs add to the pressure by raising the cost of aircraft parts and jet fuel, which in turn drives ticket prices higher for families planning long-haul vacations. Even small increases in airfare can discourage visitors, especially as global destinations compete for the same tourists. The scars of the 2023 Maui wildfires remain fresh, with thousands of homes destroyed and confidence in Hawaii's infrastructure still recovering. Hotel bookings have yet to return fully to pre-disaster levels, and higher travel costs only make the rebound more uncertain. For Hawaii, fragile tourism demand means that one external shock could quickly ripple through jobs, tax revenues, and community stability. Number 4. Kentucky. Kentucky relies heavily on federal support, with about 43% of its state spending tied to federal funds. That dependence creates significant vulnerability when Washington makes budget cuts or shifts priorities. In July 2025, Medicaid reductions added fresh pressure, threatening rural hospitals that already operate on razor-thin margins. These facilities are often the only lifeline for small towns, and their closure leaves entire regions without accessible health care. At the same time, Kentucky's workforce has been weakened by one of the highest opioid addiction rates in the country. The crisis lowers labor participation, drives up health care costs, and undermines efforts to attract new investment. Private capital has been slow to flow into the state, limiting growth beyond federally supported projects. For Kentucky, the combination of federal dependence and a strained workforce means resilience is thin, and one national shock could deepen local economic pain. Number 3. Nevada. Nevada thrives on entertainment, gaming, and consumer spending, but that strength is also its greatest weakness. More than 72% of the state's general fund revenue comes from sales taxes and gaming taxes directly tied to tourism and household consumption. When Las Vegas and Reno are booming, the tax base swells and state services remain funded. But when families cut back on vacations or entertainment, revenues can collapse almost overnight. Tariffs magnify this risk by pushing up the cost of goods, travel, and leisure, leaving households with less disposable income to spend in Nevada's casinos, hotels, and shops. While Nevada currently maintains a full rainy day fund, that safety net is fragile because the entire fiscal structure depends on a single source: consumer demand. If tourism or household spending weakens, Nevada's economy has little diversification to cushion the blow, exposing just how dependent the state is on every visitor dollar. Number 2. Alabama. Alabama's economy is tightly tied to the Southern Auto Corridor, where plants from Mercedes, Hyundai, and Honda anchor thousands of jobs. That success also creates exposure, because the industry depends heavily on imported parts and steel. Tariffs directly raise production costs, putting pressure on competitiveness and threatening future investments in the state's factories. Any slowdown in auto demand quickly ripples through Alabama's local suppliers, dealerships, and tax revenues. At the same time, the state's healthcare system faces mounting strain. Since 2010, 14 rural hospitals have closed, forcing many communities to travel hours for basic medical care. The Medicaid cuts announced in July 2025 only add to the risk, putting more facilities on the brink of shutting down. For Alabama, the combination of tariff-driven auto sector vulnerability and fragile rural health care creates a dangerous double bind, leaving the state with very little buffer against national or global shocks. Number 1. West Virginia. West Virginia's economy has been tied to coal for generations, but that lifeline is rapidly slipping away. Between 2003 and 2023, coal production in the state fell by roughly 40%, eliminating thousands of jobs and leaving entire communities struggling to adapt. As mines closed, younger workers left in search of better opportunities, fueling 11 consecutive years of population decline. This shrinking tax base reduces funding for schools, healthcare, and local services, while an aging population adds more pressure to fragile social systems. Household incomes remain among the lowest in the nation, and healthcare outcomes consistently rank near the bottom. Efforts to attract new industries have been slow, leaving few alternatives to replace coal's economic weight. When tariffs raise costs for energy and manufacturing inputs, West Virginia lacks the fiscal strength or industrial diversity to absorb the shock. The state isn't just vulnerable. It is already in a slow-motion decline that tariffs could accelerate dramatically. Curveball: exemptions and trade gaps. Here's where the story takes an unexpected turn. Not all tariffs are created equal. Japan has already secured a deal to cut auto tariffs down to 15%, giving Toyota, Honda, and their supply chains a softer landing. That matters for Michigan, where the auto industry dominates, and even small relief can help keep factories running and workers on the job. The European Union is still at the negotiating table, hoping to win similar concessions for its automakers. If Brussels succeeds, the blow to America's auto heartland could be partially eased, but not every state has a safety net. Mississippi and West Virginia, for example, don't benefit from any trade backstop. Without exemptions or special deals, they face the full weight of the 25% auto tariff and the 50% duty on steel and aluminum. This uneven playing field means tariffs aren't a uniform storm. Some states get partial protection, while others take the hit directly. And that imbalance will shape which regions crack first under pressure. The next 3 months will be critical in showing just how deeply tariffs are cutting into the American economy. Mark your calendars for September 11th, when the next Consumer Price Index is released, followed by the Fed's Industrial Production Report on September 16. If CPI stays tame but factory output continues to stall, it would signal cracks beneath the surface that inflation alone can't reveal. Third-quarter auto sales will also be a key test, especially for states like Michigan and Alabama, that depend on car manufacturing for jobs and tax revenue. Tourism numbers from Hawaii and Nevada deserve close attention as well. Higher airfare and weaker household budgets could slow hotel bookings, gaming revenues, and the visitor flow that keeps these states afloat. Steel and aluminum futures will show whether rising input costs are feeding directly into construction and manufacturing pipelines. And in the Gulf, forecasters warn of an above-normal hurricane season, a risk that could collide with trade shocks to squeeze states like Louisiana. The Yale Budget Lab estimates tariffs and retaliations could shave 0.5 to 0.9 percentage points off U.S. GDP in the third quarter alone. So the big question remains: which state will break first, and what signs are you already seeing in your own community? Drop a comment below with your perspective, and don't forget to subscribe so you don't miss the next episode. Up next, we shift the spotlight from states to cities and companies, revealing who could be the next to stumble under this escalating trade war.